Hey guys, Max here, and this is your daily market update for yesterday, the 5th and the 4th of February as well. It was a pretty interesting few days. We had the US jobs report come out and that beat expectations. We saw equities rise and we saw crypto go on a bit of a tear. It was a good day to be bullish to say the least, so let's just get right into it. Now, what actually happened in the markets? Well, as I said, stocks went up. The S&P 500 posted modest gains of 0.5%, but after the awful day before where everything fell around 2 or 3%, this small rise was very welcome, and it was a bit of a surprise to some people as they thought that sentiment after the Facebook earnings report would be really poor, so the rout would continue like we saw with Netflix a couple weeks ago. Now, the Nasdaq, being tech heavy, saw a pretty strong day as well, rising up 1.6% for the day off of the back of strong earnings from some companies like Amazon, Snapchat and Pinterest as opposed to Facebook. There was also some strong sentiment regarding the US jobs report, which came out far better than expected. Some banks were predicting jobs growth to be negative by 300,000 or 400,000, but it actually came in by positive by that same margin, which eased a lot of worries. Now, we will talk about this in a moment, particularly in regards to inflation, and elsewhere in the markets, we had some worrying things happen with inflation as well. The main one here being another surge in the price of oil, as WTI crude oil has now increased to $92 a barrel, which is really quite damn high, and that's going to be pushing up transportation costs for everything. It's going to be pushing up costs outright for everything, and it's going to make inflation worse. Now, gold saw a pretty steady day, with it currently sitting just above $1,800 an ounce, as it has been for a while now. Now, crypto, as you probably saw, had a crazy day with a really strong performance. Pretty much everything rose by around 10%. Bitcoin was, of course, sitting around $36,000 or $37,000 for a few days now, but it pumped up to $41,000, where it still remains. A similar story has been seen elsewhere in the crypto markets as well. Ethereum was around $2,600, now it's sitting just a touch above $3,000. Altcoins as well saw that pump, with pretty much everything performing well. Now, crypto being crypto, suddenly everyone who was bearish and calling for 10k Bitcoin is now on the opposite side of the spectrum and calling for 100k Bitcoin. But to be honest, I still feel the exact same way about the market. For full transparency, this last week, crypto has not mirrored equities like it had the previous 2 months. Of course, the correlation between basically the Nasdaq and the entire crypto market was uncanny, and lots of people were starting to pick up on it and noticed that when tech companies did poorly, and even companies with nothing to do with crypto, they noticed that crypto markets fell as well. This last week, though, crypto seems to have moved independently, and of course, with something like this, no one is going to be absolutely sure of why this change has happened. I think it's probably related to investors who entered the crypto market earlier this year and basically made some trades in both markets as they see them both as risk-on assets, Nasdaq and the crypto ones. But as we've seen such a major decline in asset prices in crypto markets, many of these investors would have left the market or just stopped trading actively, and so there is no longer that correlating factor. Again, I don't know for sure if this is the case, but it seems probable to me, and it was something that we expected as crypto enters a real bear market when it next sees 2 or 3 years with diminishing attention before the next cycle. Now, back to traditional finance. What actually happened in detail with the jobs report? Well, as I said, expectations were very poor. A bunch of other financial institutions carry out their own surveys regarding this sort of data, and across the board, they were pretty poor. Lots of them were even predicting major declines in the number of jobs in the economy. Now, markets were worried about this, but in a strange sort of way, a poor jobs report might have actually been bullish for the markets, and this good news could be bearish. The idea here is that Powell and the Fed have spoken a lot about keeping the employment rate high, and some people believe that maximum employment is the Fed's real and only mandate. Of course, I think there's a secret mandate, but that's for another day. Now, if this is the case, if full employment is the main target of the Fed, then a strong jobs report like this means that Powell and co. are going to be more likely to raise rates quickly and to a strong degree. They're also going to be more likely to stop inflating asset prices now, to stop purchasing bonds, and even start on reducing the balance sheet sooner than expected as well. Now, this would, of course, be bad for markets and asset prices. These assets would see repricing, and stocks and shares will probably decrease by a fair margin as this happens. This report, though, the one that we got, could make Powell confident enough in the economy that he can go very hawkish. Had the report been awful, on the other hand, with 400,000 less jobs in the economy than last month, I'd bet that Powell would try and push back his rate hikes, and he'd keep quantitative easing going for a little bit longer as well, and to try and reach that full employment, so markets would be free to boom a little while longer. There's also the fact that the labour market in the US is very tight right now, as I'm sure you all know. There are more job openings than there are unemployed people, and this presents the dangerous possibility of a wage price spiral, where wages are forced up by competition in the labour markets, but those rising costs force companies to raise prices to keep up with their new higher wages, and these two factors play off of each other, and they force inflation to rise by a hefty amount. This is something that lots of economists fear, and they fear it for good reason. Now, one thing that definitely was good news and came from this report is that the labour force participation rate rose from 61.9% to 62.2%, which is actually a very good thing to see. Good for the economy, and in my opinion, is the most important figure that came out the other day. It's also been decreasing fairly frequently over the last few months, so an increase is certainly welcome, a little bit unexpected, but very good news nonetheless. Now, to be honest, I said it was a good day for equities in the market in general, and it was, but with the news that came out, I would have expected it to be a little bit stronger, to be honest. Amazon had their really strong earnings report, and it gained, I think, $180 billion of value in one day. Pinterest and Snapchat saw really strong reports as well, and they both rose 60% and 11% each. Now, when we had bad news comparable to this come out from Facebook, the markets tanked across the board and we saw 3 or 4% losses in the indexes. But when we got equally good news from a few other tech companies and some news that literally put to bed certain fears, well, the markets rose, but not by as much as they had just fallen. To me, this indicates that there are still lots of worries out there, that some of them were put to bed, like the worry behind Apple's change of their privacy policy that basically makes it far harder for tech companies to gather data. Facebook blamed some of their failings on this change, and so lots of investors expected every other tech company to have experienced the same problems, but that doesn't seem to have been the case. Snapchat, for instance, have said that there is a change in the amount of data they can collect, and it's not exactly good news that it has decreased for them, but it isn't enough to derail their entire business. Now, in some smaller bits of news, Peloton is apparently attracting some attention for a takeover bid after its share price has collapsed over recent months. Apparently, it's looking a little bit appealing, and to be honest, Peloton always should have been a subsidiary of a company like Apple or Amazon. It always should have been part of a bigger ecosystem and was just never cut out to be a tech company on its own. Now, it seems as though Amazon is interested in considering a takeover. They have loads of cash and a very wide net for businesses. They're involved in almost everything, of course, and Peloton wouldn't be an awful move for them. I could see them quite easily work the subscription service into Prime membership somehow, maybe a new version, give some sort of a discount. They could easily sell all the equipment they have, and they have more than enough cash to run the company as a loss leader for years to come, something which Peloton alone could never really afford to do. Now, just a very quick bit on geopolitics. We saw Russia and China come out and strengthen what is sort of an alliance between the two countries. Russia came out and said lots of things regarding Taiwan, that it's not independent, never will be, and that it belongs to China, yada yada yada. Then China came out and said that Russia is doing no wrong regarding Ukraine, that it's just defending its interests in regards to Western aggression, yada yada yada. We're going to cover this all in detail tomorrow. One thing that they did agree on specifically, though, was to work together to stop NATO from expanding, and they outright said that the West should drop the Cold War mentality. To be perfectly honest, though, this is a Cold War mentality, and this is exactly where we're going, towards a second Cold War, just with the main antagonist being China, not Russia. Of course, Russia really isn't that powerful a country anymore. Their economy is smaller than Italy's and it's not going to grow anytime soon. They have a very big, scary land army filled with conscripts and aging technology. Every year that passes, the reality of the Russian economy sets in a little bit harder, and the Soviet-era power that lingers decreases as well. Basically, China will be public enemy number one. The only reason that it isn't literally an enemy right now is because corporate interests are too strong. Trade relations are too close, and it's not feasible for a real Cold War right now, but over the next decade, I fully expect to see Western companies slowly decouple from China, and as they do, things will change, relations will deteriorate, and a second Cold War, in my opinion at least, looks very likely. Finally, in a tiny bit of domestic UK politics again, Boris Johnson is still under lots of pressure, and what I've been saying continually is to pay attention to what Tories are saying, Tory aides, backbenchers, and even the cabinet, because those are the only people who can actually put out that pressure that might lead to Boris leaving office. Now, there is going to be a vote to decide upon a vote of no confidence, which could force Boris out. If 15% of Tory MPs want this vote, then it will come, and that's 54 people, and it looks like most people are predicting between 35 and 50 MPs will support it, so it is definitely a possibility and something to pay attention to. Now, we will talk a fair bit about developments regarding Ukraine tomorrow, the situation with COVID around the world, and we'll probably also touch just a tad on the Winter Olympics a little bit. It's not going to be something we go into great detail over, don't you worry, but there are some interesting things there to touch. That is it today. I will be back tomorrow, of course. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. It is now February, so if you've been waiting to join, now is the perfect time. There's also a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you get from any savings account these days. Just make sure not to use Tether. Thank you all for the support, thanks for watching, stay stoic, until next time.